Good morning. Why cap rates no longer tell the full story, and what lenders are actually using to approve or kill deals in 2025. So, for decades, cap rates were the go to metric for valuing commercial real estate. And they were simple, widely understood, and effective in a low rate environment with stable credit as well. That world no longer exists. So, in today's higher for longer rate environment, cap rates alone fail to capture financing risk, cash flow durability, and lender tolerance. And as a result, lenders are underwriting deals through a more layered lens, one that prioritizes debt yield, DSCR, and cap rate spread over headline pricing. Now, if you're still anchoring decisions solely on cap rates, you're underwriting yesterday's market. So, the problem with cap rates in today's market, well, cap rates measure unlevered yield, not financing risk. So what that means is they ignore the actual debt costs, the loan structure and amortization, but also interest rate volatility in the market. And there is no cash flow sensitivity under stress. So in a 3% interest rate world, that didn't matter as much. And in a 6.5 to 8.5% debt market, it matters a lot more. And the disconnect is why many fairly priced deals just don't size like they used to, or fail lender DSCR tests, or require unexpected equity infusions, or just stall in credit committee. What lenders care about now, a 2026 underwriting reality. So, number one is cap rate spread, not just the cap rate itself. Lenders now focus on the cap rate spread over the note rate and not the absolute cap rate. So, why it matters, a narrow or negative spread signals refinancing risk and limited exit flexibility. So, let's look at some typical lender comfort zones. 200 to 300 basis point spread equals a strong case. 100 to 200 is a cautious case. And under 100 basis points, there's potential for credit stress. And a 6% cap isn't good if the loan price is at 7.25. So debt yield, the new credit anchor. So debt yield is the NOI divided by the loan amount itself. And this metric answers one core lender question. If we had to take this property back, does the income justify the loan? So why lenders prefer it? Well, it ignores interest rates and amortization, and it cannot be manipulated with leverage. And what it does is it reflects the true income support for the loan amount that's going to be advanced. So here are some common 2026 targets. Multifamily and industrial, 8.5 to 10. Office and specialty, 10 to 12. And deals with strong debt yield still close, even when cap rates look tight. Number three is DSCR, cash flow margin for error. So DSCR equals the NOI divided by the annual debt service. And what the DSCR determines is your loan proceeds and any interest-only eligibility, but also the reserve requirements and any pricing adjustments the lender needs to make. So let's look at what some typical lender minimums are. 1.25 to 1.35 is a general benchmark for stabilized. And it could be higher for transitional short-term debt. And if DSCR fails, the deal has to restructure or die. So why this matters for investors and owners? The cap rates are still relevant, but they're no longer decisive. And in 2026, capital markets discipline has shifted power to lenders, and underwriting now rewards conservative leverage, durable NOI, and clear exit paths, but also realistic refinance assumptions. And this is why experienced borrowers are underwriting to their debt yields first. They're stress testing their DSCR, but they're also using cap rate as a contextual metric, not the anchor. And how a mortgage broker adds real value here. And this is really where most deals break or get saved. So a strong mortgage broker will have a good sense and be able to structure leverage around lender metrics and not just broker assumptions on a broader market scale, but actual experience with that lender. But also matching assets to the right capital stack and anticipating credit committee objections before submission, which helps align pricing expectations with the executable debt that's available. And at Medallion Funds, our job isn't just to quote rates, it's to engineer approvals in a tighter credit market. So here's the final takeaway. Cap rates tell part of the story. Debt yield, DSCR, and cap rate spread tell lenders whether the deal actually works for them. And if you're underwriting like it's 2019, you'll keep getting rejections like it's 2025. So if you want deals to close, you need to think like the capital providing the money. That, my friends, is it for the day. Please visit my website, billrapponline.com, to figure out how to get a hold of me, and love to help you reason through whatever situation you're facing. Have a good day.